HUTAYA analytically S.BALAKRISHNAN, non-metric is 23DBS23 F1053.
Hi, my name is Muhammad SYAZWI bin ABDUL. My number metric is 23DBS231049.
Assalamualaikum, my name is Athirah binti IBRAHIM. My metric number is 23DBS23F1017.
Assalamualaikum, my name is ASYIQIN. My matrix number 23DBS23F1005.
Accounting is a process of recording, classifying, summarizing, reporting, analyzing, and implementing business activities into monetary units to assist users of this accounting information in decision making. The 6 elements are crucial components of the definition of accounting. The first element is recording. Recording the first elements of accounting involves systematically recording financial transactions and events. This includes documenting all financial facts such as sales, purchases, expenses, and investments. The purpose of recording is to create a permanent and organized record of this transaction. The second element is classifying. Classifying after recording transaction accounts, classify them into various categories or accounts. These steps involve organizing financial data into specific accounts such as assets, liabilities, equity, revenue, and expenses. Proper classification ensures that financial information is structured in a way that is useful for reporting and analyzing. The third element is summarizing. Summarizing accounts summarize financial data to create financial statements. These statements including the balance sheet, income statements, and cash flow statements provide a concise overview of an entity's financial position and performance. Summarization is essential for presenting information to internal and external stakeholders in a clear and under manner. The fourth element is reporting. Reporting accounts prepare financial reports such as annual reports, financial statements, and various financial disclosures to communicate the financial information to stakeholders, including investors, creditors, management, and regulatory authorities. These reports provide a clear and comprehensive view of entity financial situation and are essential for accountability, and transparency. The fifth element is analyzing. Analyzing accounting requires the analysis of financial data to understand and interpret its significance. Accounts that various methods and techniques to evaluate financial information, identify trends, assess performance, and make informed decisions. Financial analysis help in assessing the financial health and performance of an entity. The sixth element is implementing. Once the financial data is summarized, it needs to be interpreted to derive meaningful insights and conclusions. Accounts and financial analysis. The financial statement to understand an entity financial health, profitability, liquidity, and solvency. Intervention helps the stakeholders make informed decisions such as investors deciding whether to invest in a company or managers, assessing the performance of a department. These 6 elements collectively define the process of accounting, which is to provide a structured and reliable system for recording, classifying, summarizing, reporting, analyzing, and interpreting, enabling individuals and organizations to make informed financial decisions and assess their financial performance.
Certainly, here are description of internal and external users of accounting information along which 3 examples for each category. Internal users are individual or group within an organization who rely on accounting information for various purposes related to managing and making decisions within the company. Management, the top executive and department heads within an organization use accounting information to make strategic decisions, set financial goals, and monitor performance. For instance, the CEO might use financial record those in managerial position may use accounting information to understand the financial health of organization. For example, the HR manager might review financial statement to determine the company ability to offer salary rises or bonus. Owner, business owners and shareholders rely on accounting information to assess the value of their investment. They examine financial reports to evaluate the company profitability, growth prospect, and to make decisions about buying or selling shares. External users are individuals or entities outside the organization who use accounting information to assess the financial performance and stability of the company. Investor, individual and institutional investors such as mutual fund use accounting information to decide whether to invest in a company's stock or bonds. They are interested in understanding the company's financial performance and growth position. Creditors, bank and other lenders use accounting information to evaluate a company's creditworthiness when deciding whether to extend loan or credit lines. They want to ensure the company can meet its financial obligations. Regulatory authorities, government agencies and regulatory bodies require access to accounting information to enforce tax law, financial regulation and protect the public interest. They use the information to ensure companies comply with reporting and tax requirements. In addition to these primary users, there are also other stakeholders like customers, suppliers, competitors and the general public who may indirectly benefit from accounting information. This information helps provide transparency and accountability, contributing to a well-functioning business environment.
Here are 10 business transactions, each involving one of the specific document and the corresponding journal or book where the transaction would be recorded. First, transaction with a purchase order. Purchase order will be put in purchase journal. The explanation is company issue a purchase order to a supplier to buy raw materials for production. This transaction would be recorded in the purchase journal when the goods are ordered. Second, transaction with a delivery order. Delivery order will be put in purchase journal. The explanation is the company received a delivery order from a supplier confirming the shipment of the purchased raw materials. The entry in the purchase journal acknowledges the receipt of goods. Third, transaction with invoice issue. Invoice issue will be put in sales journal. The explanation is the company sells products to a customer on credit and issue an invoice. This transaction is recorded in the sales journal reflecting the revenue from the sale. Fourth, transaction with invoice received from. Invoice received from will be put in purchase journal. The explanation is the company received an invoice from a vendor for office supplies purchased on credit. This transaction is recorded in the purchase journal, representing an account payable. Fifth is transaction with cash bills. Cash bills will be put in cash book. The explanation, the company pays cash bills for office utilities like electricity and water. This transaction is recorded in the cash book reflecting the cash outflow for expenses.
Number 6 is transaction with credit notes. Credit notes will be placed in return inward journal or sales return journal. The explanation for this is the company issue a credit note to a customer for return damaged goods. This transaction is recorded in the return inward journal to reduce revenue. Number 7 is transaction with debit notes. Debit notes will be placed in return outward journal or purchase journal. Explanation for debit notes is the companies receive a debit note from a supplier for an additional charge on a delivered item. This transaction is recorded in return outwards journal to account for increased expenses. Number 8 is transaction with official receipt. Official receipt will be placed in cash book. The explanation to official receipt is the company issues official receipt to customer who make payment in cash. These transactions are recorded in the cash book reflecting the cash inflow. Number 9 is transaction with payment vouchers. The payment vouchers will be placed in cash book and general journal. And the explanation for payment vouchers is the company creates payment vouchers to record and authorize the payment of rents. These transactions are recorded in the cash book for actual cash disbursement and the general journal for accounting purposes. Number 10 is transaction with memo. Memo will not be recorded in a journal book. This This is because it does not contain debit and credit amount. The explanation is the company prepares a memo to document an internal transfer of funds between departments. Memo are typically used for internal communication and are not recorded in accounting journal. Please note that the specific account and amount involved would be vary based on the nature of transaction and the company's accounting system. That's all from us. Thank you for watching.